Welcome to Nasdaq Trade Talks, where we meet the top thought leaders and strategists in emerging technologies, digital assets, and the regulatory landscape. I'm Jill Malandrino, global markets reporter at Nasdaq, and joining us at the Nasdaq Market site, we have Chris Dearborn, Managing Director on Nasdaq's Market Intelligence Desk, as well as Michael Normyle, U.S. Economist at Nasdaq. We have Steve Wyett, Chief Investment Strategist from BOK Financial, and Steve Sosnick, Chief Market Strategist at Interactive Brokers, for what's a very special edition of our mid-coverage today, having both Steves in studio with us. And you know, Steve Wyett, we could not ask for better timing in terms of all the variables we're trying to consider at this point.
Better or worse timing, I suppose, right? I mean, there's so many things that are happening right now. And I just look at, I would look at the action in the market today just as a microcosm of how the level of uncertainty is so high at the present time. And you know, when news comes out and we see huge swings in the equity markets, plus and minus, I think it's really difficult. If you're a trader, that's fine. I mean, crypto traders are probably going, bruh, welcome to our party, you know. But it's, but I think from a longer term perspective, this is just such a high change environment where it's not just the number of policies in play, but it's the speed at which they're moving and the interaction of them and the unknown of the outcome. So it's a really interesting time to be.
Right, and Steve Sosnick, the one thing we do know is there will be an outcome at some point. Yes. So there are opportunities to think about as a longer term investor, and that's, you know, naturally what we cover on the show here. I would say more near term, what we're seeing with weakening economic data and questioning how this can impact the consumer, that seems to be what's front and center right now.
The consumer really is front and center because, you know, we started talking, I think you and I started talking about this over a month ago, was the numbers started really declining. The UMich numbers started to show weird drops in sentiment and weird pricing in of inflationary expectations. Those continued. Then we got lousy retail sales, and obviously Michael can talk more about, you know, government numbers of that nature, but the retail sales numbers were atrocious. Walmart basically confirmed it, and nobody's got a better pulse of the consumer than Walmart. And so I think that the pace of the government, the changes via Doge and the fear of tariffs and just, you know, price of eggs, for lack of a better word.
When did eggs become like a cultural movement? I mean, when did this obsession with eggs start?
I don't know, because gasoline has been relatively tame. The price at the pump's been, you know, actually, you know,
it's falling. So
it's been falling. Crude, you know, I'll defer to you on the oil patch, Steve, by all means. But you know, but so eggs are the thing now that people buy regularly that are going crazy.
That's the new benchmark, huh,
yes.
Michael? Okay, so Michael, you and I have spoken about this before, where when you think about the unemployment rate, 4.1, 4.2, 4.3, you know, a tenth of a percent is not really going to move the needle. Is there anything that you've seen with economic data where, okay, the needle might have moved?
I think actually the interesting thing to start the year is how much noise there's been in the data. With CPI, there's questionable seasonal adjustment happening at the start of the year because in the post-pandemic period, companies have been increasing prices in January a lot more than they had been. That's not fully integrated into their seasonal adjustment that happens just yet. You've got bad weather to start the year. You've got people front-loading purchases to get ahead of tariffs, and so then you see a payback with the January PCE spending data this month. On top of that, with the bad weather impacting retail and impacting cars and impacting recreation spending. So I think a lot of the data, it's just more noise than signal right now. And with things like the consumer surveys that Steve was talking about, you've got the change in the party leadership. If you look at the inflation expectations for Republicans for 1 year, it's 0%. If you look at Democrats for 1 year, it's 6%, along those lines. So it's completely become politicized, and so these indices they've become less reliable in the last few years here.
That raises my question then, is if you're seeing this, I would presume some of the economists at the Fed are seeing this, wouldn't that push them to the sidelines a little bit longer? And you know, I think one of the fears that we're seeing in the market is that the economy is acting poorly, and yet the Fed might be a little hamstrung about moving quickly. Do you see that as a risk from the economics point of view?
Well, yeah, I think we get these stretches of weird data from time to time too. Like if we think just last summer, right, there was the whole unemployment rate increasing so much that we had the Somme rule breached and everyone worried about recession for 2 weeks. And then that went away, and the third quarter ended up to be quite strong actually. So these types of things aren't, I think if we couldn't explain what was going on, then it's time to worry. I think there's a lot of stuff that you can kind of explain away right now.
Yeah, that's a good nuance that you bring up there. But Chris, On the Market Intelligence Desk, your team, you're talking to Nasdaq listed companies, our issuers directly. You focus on consumer. Is there anything that you can discern from the folks that you're speaking with in terms of forward looking?
There's a lot of uncertainty, as discussed, and the headlines have covered across the board. You know, as you said, Steve, they're coming fast and furious. The headlines, the policy changes are moving along with it. Whether or not actual policy change does happen is one thing. It's the headline that grabs it. And as a former trader, you're looking at the headline, you're trading on the momentum. You look at the VIX with the 26 handle a couple days ago, we're down about 7% today to 21 handle. Look at the market action. You look at the indexes to the smaller cap companies. Nasdaq, we have a lot of the smaller cap companies listed here. So you look at the S&P 600, the Russell 2000, you're breaching 200-day moving averages in those indices. You're having RSIs that are trading below 30, considerably oversold. Russell's a major player there, been oversold, but you are seeing a double bottom in the RSI for the S&P 600. So the mid cap is off about 10%. Since the November highs, the small cap is off about 13%, the Russell's off 13%, but then all we talk about though is the large cap names because
but you know,
AI,
though, Steve, we spoke about this with Maddie, who's our small cap specialist on our desk yesterday. Once we get a tariff strategy, right, we know we're going to get it at some point, some of those smaller cap names that their production, their manufacturing is based in the US, that could potentially be a catalyst. I know small caps haven't really passed the starting line, but there are some silver linings potentially.
Yes, I mean, look, the idea is with the tariff strategy, and I think the way President Trump is approaching this, which is different than what we've seen in the past, but his idea on this is a deglobalization strategy. This is about bringing jobs and manufacturing back to the United States. This is about righting what he views as some wrongs in the trade policies that we've had in the past. And so as you go through that, yes, those companies that are more domestic centric, that have less international business, they could conceivably benefit from that. But I think the bigger problem with the Russell right now is, what do you still have? 40% of the companies don't make money.
Correct.
Well,
and
so
they're dependent on the interest rates. Right?
Yes,
We're now
so that's
pressing
an
in 3
interest
cuts
rate
for this
trade.
year. It is.
It's an
To a
interest
point, but it's also a larger cap trade. So to the consumer question from before, you're seeing large cap names seeing a bid for the stocks when they sell off, especially on moderate to negative news, which comes in the face of uncertainty around tariffs. There's supply chain issues. A lot of the companies have supply chain issues, and they're not sure what that cost of capital is going to be right now. The smaller cap companies may report better earnings. However, there's no bid because you're not going to catch the falling knife in the broader index because you're not sure where it's going to play out. The larger group may oversell the better one. For a good example, look at the S&P 1500 Consumer Discretionary Index. It'll tell the same tale.
Right, and well, Steve Sosnick, do you really want to take a position long or short overnight? I mean, it's, you know, as an intraday day trader, it's a little bit hard to position here.
It's very tough, and markets are showing their illiquidity right now.
That's
and,
it.
And let me, Chris, as a former specialist, you probably know where I'm going with this. Yeah. You get a lot more, once markets, volatility at some level sort of begets volatility. And what happens is, this is just normal market maker behavior. We used to have, you know, when we were options market makers, we'd have a sign in the room, and it was basically above the desk, big bold letters. Number one, raise vols. Number 2, widen spreads. Number 3, cut sizes. Well, the first part, raising vols, you see that in the VIX. But if you're widening your spreads and cutting your sizes, what does that mean? It means the market is less liquid by definition, and it means that it takes smaller amount. If you have motivated buyers and sellers, it takes less to move the market the same amount as it would on just on a non-volatile day. So you do get this, and you know, so as we're speaking now, the SPOOs were zooming, and you know, the FOMO is still there. Nobody wants to miss that bottom, and if you're a motivated buyer and willing to chase, it's going to move further and faster, and which is also why yesterday we ground higher all day, and then there was that rug pull at the end of the day. This is reflective of it. So you have to, if you're an active trader, you have to adapt your strategies. And my comment there would be, if you're willing to try to buy on the bid and sell on the offer, you've got more room to do that. And why not think like a market maker in those situations, rather than just reflexively hitting bids and lifting offers?
Because it seems as if the pattern has been kind of sell off in the morning, get this ramp up in the afternoon, and then going into the close. Seems to be nobody wants to be taking a position overnight.
Well, we did have a couple of days which were the opposite, right? Like last Friday, where you had that weird end of the month markup because again, once it got moving, everybody jumped in. Nobody wanted to miss that move. It was a Friday, so you had weekly options expiring. That I think exacerbated it. And we had a couple. I think it was Tuesday before we had one of those as well, a week ago Tuesday. So we have had a couple of those as well. But this is what it means: is at the end of the day, if people want to square their positions, it's harder to do it, and it moves the market more in either direction.
Yeah.
Smaller caps more so.
Yeah.
Yes.
Michael, I'm curious though, as the trade structure is going to look different, whether it's tariffs or onshoring more, less globalization, I wonder from an economist perspective how that's going to impact forecasting, because the environment is quite different than the past several decades.
Yeah, I mean, it's also the same thing we've all been saying, right? There's a lot of uncertainty. So it's still guesswork because it's, okay, we have 25% tariffs on Canada and Mexico now, but for how long? And if it's for a week, that's a lot different than if it's for 6 months. So it's really just kind of put your finger in the air a little bit, you know.
Well,
I
on
mean,
the
Steve
autos,
Wyett,
we're
you
giving
saw
them a
the-
1 month reprieve this afternoon.
Right.
Yeah,
Well,
and
I
you'll
mean,
fix
look-
your supply chain in 1 month, right?
That's correct.
Well, there's that as well, which is why the small cap domestic companies that already have their stuff here could benefit. But Steve Wyett, the enthusiasm that we had coming into the year, you can't ignore some of those returns in 2024.
No, but look, the enthusiasm that we had, I think in the end what investors are starting to realize is that to get to where we want to be, where we think is this better place, there's going to be some pain to get there. To your point, we globalized for 30 years. We're not going to deglobalize in 3 or 4 years. This is going to take a longer period of time. And I think that the other part of this is that as you start thinking through, not just tariffs, I get more questions on tariffs than anything right now. But the bigger issue from our lens as we think about how the economy moves forward is immigration policy and what that's going to mean. I mean, down to maybe the size of our labor force versus how much output we're going to need, the fact that we're $37 trillion in debt already, and what that may mean to overall economic growth if we start hamstringing our ability to actually grow our labor force. Now, nobody's saying that we want criminals from other countries in our country. We got enough homegrown criminals to worry about that. But we also know that while I think the data that I've seen, it's 6 to 8% of our entire labor force might be undocumented. If you get into certain industries like construction and leisure and hospitality and others, I mean, it's 15, 20% of the workforce. Those are going to be really important industries for us as we think about how we're moving forward. And so if immigration policy gets a little too aggressive and we start losing the people that are actually part of the workforce, that's going to be, it just raises that growth question again, broadly. And the other part of that, of course, is now we're seeing the reaction from our trading partners and what they're doing, and now they're talking about spending more money. So I personally haven't lost sight of the fact that I think developed international stocks have outperformed the S&P 500 by something like 9% year to date.
Yep.
Now, they've got a 15-year period of underperformance to overcome, but it's just reflective of some of this shift. And when I think about the government statistics, look at what happened to the Atlanta Fed this week. I mean, I don't know if we've ever seen a shift from plus 1.5 to -2 based on a couple of numbers, but this was a result of companies making actual decisions to front run a bunch of imports. Exports stayed pretty well stable, and of course, within our GDP calculation, that's a negative for what GDP looks like. So it's really interesting as how those things fit together.
Yeah, Steve Sosnick, I would also argue too the European trade, the risk was to the upside because of the disparity in performance, right? So I think even before the U.S. markets really started to get rattled around tariff uncertainty, that trade was in place for that reason. I mean, because everything was overvalued here.
Well, that's it. If you're a value investor, there were values to be found in Europe. Now, some of the moves there have gotten extreme too. I mean, European defense stocks, Saab and Rheinmetall and some of these other ones have gone truly bonkers. But, in Germany today, they basically undid essentially their entire post-war constitution today in terms of allowing them to borrow more money to run budget deficits.
German trends were up 20 basis points today, 25 basis points today.
Exactly. So you had the German DAX was up 3%, and it was, I believe, the worst day for German bonds in ages. I don't want to put a number on it, but I just remember reading and going, oh my, that's a long time. So I don't know exactly what it was. So these are seismic changes that are going through, and yeah, there's more of a runway in Europe. I don't think the intent of the policy was of the president's policies was to make Europe great, but I think that's.
I actually read a piece today. The headline was
really?
Trump is making Europe great again.
but in the short term, that seems to be it. And you know, I got my start trading international stocks, and so there are values to be had there. There's a lot of great companies outside our borders, and for some reason, you know, Europe has not gotten on the radar tariff-wise, so they've got some sort of head start over, you know, Mexico, Canada, China. They're in a little bit of a sweet spot right now.
Yeah, I mean, Chris, it makes you wonder if the TINA trade just got played out here. You know?
It seems like it, right? I do have a question for Mike, though. We got the jobs report this Friday. ADP was a little bit low. What do you think? Is it as impactful if it comes in with mixed messages, or if it comes in at 4% like it's supposed to, then it's a non-factor?
Well, I think first of all, ADP and the official jobs numbers are not
never
never really
in line.
match up.
Right.
So I wouldn't worry about a disappointing ADP number necessarily. But yeah, I think what I saw, I've seen expectation is maybe a slight increase in unemployment rate, but then also the like a 150 or so for February. So still a pretty solid number.
You still think wages are declining?
In general, yes, yeah.
I mean, it's a weaker labor market across the board. And if the immigration situation, as Steve mentioned before, continues to happen, there are plenty of public companies and private ones that do rely on that workforce for a number of our basic goods.
Right.
And that's going to impact across the board. So, you know, not to shift from the TINA question, but that's something I want to.
But let's talk about longer term demographics for a moment here. When we're looking, you know, 10, 20 decades out, our demographics here. I think that's going to be an issue. I mean, it's almost like Japan, where we don't have enough younger people that are going to have to fund a lot of this.
So I think as we approach this issue, which, you know, the hard part about immigration, and by the way, a whole lot of the other stuff we talk about, it gets painted with this political brush really quickly. Right. That's not how any of us are thinking about this. This is we're thinking about markets and growth and earnings, and the fact of the matter is, if you look at our domestic demographics, our population growth is going to go negative in the next 10 to 12 years. If we didn't have $36 trillion in debt, that's, you know, you could manage around that, but we do. And so as we start thinking about how we're going to deal with that, I just think it puts us in a position where economic growth is going to be so important. Now, there's another big lever with productivity out there, and there's the opportunity for AI to play a huge part from a productivity standpoint. But it would be, in my mind, it would be really difficult for productivity to consistently pick up the slack for a shrinking labor force over time. That's historically a much more volatile path on productivity. And so I think this is where we just need to think about that issue and step back from the politics from it, and it's just a math issue. We're just talking about the size of our labor force and what that means, the skill sets that we're going to need, and I think that could be some headwinds to growth as we move forward.
And Steve Sosnick, to wrap up here, we're almost at time. I would agree with the other Steve. I can't remember the macro and geopolitical environment so intertwined with the market like it is. I mean, it's an inescapable conversation.
But I can't remember a situation where things were moving so fast from a governmental point of view. Right? The whole point of government is it moves slowly. And what has it been, 40 some odd days? It's called 7 weeks. And this is, and the pace of what we've seen is unprecedented. So, yeah, basically move fast and break things. You do have, Elon Musk, and
well,
that's
that works
kind of
for a startup.
But that's Elon Musk's motto, and he's in charge of a lot of this stuff. And so, I'm not saying that even politically, but this is very difficult because you just have these dislocations that we've never had to deal with before. A lot of them are coming from the government, from the government sector. We didn't even really get into where the G is in the, C plus I plus G and GDP, and how that's going to may or may not affect things. So, and the problem is markets are usually lousy at doing geopolitics. This is like one of their weak things, and here we are forced to wrap this all into a market context, as Steve mentioned. It's tough, and so this is where volatility comes from, uncertainty. And we don't know, and it doesn't appear that we're going to have a lot of clarity in the immediate future.
All right, well, we'll see what the conversation looks like next month, because it could really look different. Appreciate everyone's insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.